Hello folks, Charlie Gipple here with CG Financial Group. We're going to have some fun here. I want to, over about I would say 10 minutes max period of time, I want to explain the difference between whole life insurance and indexed universal life insurance. I would say I'm going to talk about which one is best, but that would be a complete BS video, right? Because believe me, I have walked barefoot for 500 miles across a barren desert in 200-degree heat without water for 5 months, trying to find the answer to the question of which one is better, IUL or whole life insurance. I dug into IRRs. I dug into, well, without dividends versus with dividends versus index universal life insurance, the projected value versus the guaranteed value. And what about no lapse IUL policies? IUL policies that have a secondary guarantee, is that better than whole life insurance? There is no answer to the question. There is no answer to the question, so you might as well take that. Take that question out of your vocabulary or lexicon or list of questions to ask wholesalers. Don't ask it, because there is no answer. It's like saying which one's better, stocks or bonds. Well, if you're talking to a 22-year-old, stocks are probably going to be better. If you're talking to an 80-year-old, bonds are probably going to be better. And by the way, for the compliance vigilantes out there, don't bust my chops, because I'm not saying that index UL is like stocks and whole life is like bonds, but you get the analogy there. By the way, kind of an extension of this video is one that I did recently on these banking concepts with life insurance. That's a 30-minute video. But if you want that video explaining through the lens of how a life insurance policy works when there are loans taken against it, explaining what these banking concepts are, send me an email. I'll get you that video explaining what these banking concepts are and what they are not. I love the banking concepts for what they are. I do not love the banking concepts for what they are not, but yet many times are explained as things that they are, if that makes any sense whatsoever. Whole life insurance versus IUL. In a nutshell, indexed universal life insurance, it's designed on a chassis that uses what I'll call forward pricing or expectation pricing. Now, what the heck do I mean by that? And by the way, I would say that whole life insurance is based off of just maximum pricing, but yet truing up that pricing in hindsight. That makes no sense. Don't worry, I'm going to explain it to you. So this thing here is supposed to be a straight line. This thing here is called a mortality curve, right? You've heard of the 2017 CSO mortality table. It used to be the 2001 CSO mortality table, but what these mortality tables are is the regulators give insurance companies the maximum amount of mortality. So there's age. The older that you get, the more likely it is that you're going to die. Within a pool of 1,000 people, 10,000 people, 100,000 people, more of those people are going to die of a certain age, right? And recently we had to switch over to the 2017 CSO mortality tables versus the 2001. Now, the way that indexed universal life insurance is priced is the insurance carriers look out into the future and they say, you know what, we underwrite pretty darn good. Yes, we have these maximums that we cannot go beyond. We cannot go beyond those because, well, we'd be run out of the state. We just can't do it. But we price pretty good. We underwrite pretty good in that. And we, the insurance company, believe that maybe only half of what the mortality table shows, is actually going to die under our purview, is actually going to die on our watch with our company. So what that insurance company does with that indexed universal life insurance policy is they set the annual cost of insurance charges, so maybe it's half. And by the way, it doesn't have to be half all the way. Like good cash value, good long-term cash value policies have really high upfront cost of insurance charges, but then over the long run, it tapers off. I won't go into the reasoning why that is, but let's just keep it simple and say that we're at half the maximum. But then as the year goes by, well, half of the maximum, so the cost of insurance charges are being charged to the client month by month by month, right? And by the way, that client's money has been invested in the general account portfolio. That general account portfolio is spitting out a yield in which the carrier is able to buy call options, right? And in addition to that, the insurance carrier is charging per thousand charges to the client, which takes care of the administrative costs, the lights in the home office of that insurance company. So what did I just discuss? What I just discussed, keep this in mind, this is very important. What I just discussed were three different things. The insurance company is covering their mortality exposure, right, via the cost of insurance charges. The per thousand charges are covering the expenses that the insurance company has from an administrative standpoint, but also the performance of the general account portfolio is what determines the call option budget year by year by year. Those three things. There's a reason I just mentioned those three things. So now let's go over to whole life insurance. Whole life insurance, with whole life insurance generally, I don't know of any exceptions to this rule. I don't know if it's a law that whole life insurance companies have to do this, but generally whole life insurance carriers, they will charge the 2017 maximum CSO mortality table. Actually, I do know there are exceptions to this. But generally, let's say that the whole life insurance companies are charging the maximum, right? What the whole life insurance carrier does is at the end of the year, though, and I'm not saying that they're bad people for doing this. No, you'll see that it kind of washes out in the end. But at the end of the year, the whole life insurance company says, okay, so we're at the end of year one here. But looking back in hindsight, our mortality exposure was actually pretty good. We only had that amount of people die. Or maybe they did better than the IUL company. Maybe the whole life company, only had that amount of people die or whatever. We only had that amount of people die. So we owe our clients some money, right? Because we charged this and we were only experiencing an expense of this. But then the whole life insurance company says, but then on top of that, what we did is we had investment performance that was beyond what we priced into the interest rate that is embedded into our whole life insurance policy. So far, what have we talked about? We've talked about cost of insurance. We talked about mortality, right? We also talked about the investment performance. But there's a third thing, remember? There's a third thing. A lot like with the IUL company, there's a third thing with whole life companies. There's only 100 pennies in the dollars. It's just a matter of how these carriers calculate the value that the client gets, right? They're the same thing. It's just a matter of the different philosophies. That third thing is the whole life insurance company says, you know what? We've done pretty good from an expense management standpoint as well. So we owe our consumers back this amount of money. That amount of money, there's a calculation done, and congratulations, Mrs. Client, you get a quote-unquote dividend of 5%. So what I just explained with the IUL was the investment experience of the company is what determines that is the general account, i.e. the investment experience determines the caps, the call options, right? The second thing is the per thousand charges as well as premium loads. Those are the administrative expenses. And then, of course, the cost of insurance charges. The dividend calculation with whole life insurance carriers. The dividend calculation with whole life insurance carriers is this. It's three primary things. And you punch into Google or whatever, 3 variables and dividend, whole life dividends or something like that, and you will find this. It's the performance of the general account, the investment performance. It's the mortality exposure versus what the whole life insurance carrier priced into it. And it's how well they have managed their expenses. It's the same thing, right? It's just a matter of, what it comes down to is it's just a matter of, and by the way, with whole life insurance, what I just said is a consumer is overpaying for their coverage, but then getting a refund back at the end of the year. To where with IUL, it's like, hey, you don't have to overpay anything. Now, we may adjust up what your expenses are as time goes by, and in the end, it'll all wash out. But it's just, with IUL, it's kind of just-in-time pricing, and with whole life insurance, it's based off looking back and truing that up and down with what the exposure was. That's the only difference there, right? That is the only difference. Another major difference is the range of possibilities. Because when you think of whole life companies, it just comes down to the experience of the general account when it comes to that one of three components, that investment experience component, right? With indexed universal life insurance, instead of the client saying, yeah, give me my 4.6% rate of return, or 4%, whatever the general account may spin out and give on a current assumption UL, or give via interest plus dividends on a whole life policy. The client instead is saying, instead just go buy call options and give me bigger upside potential, but of course, smaller potential in the downside scenarios, right? So it is kind of like whole life policies, kind of like bonds, where indexed universal life insurance, kind of like the stock mentality. Now, I know people are, but you can't get negative 20% with indexed universal life insurance, so it's not like a stock. Well, I'm not saying it is like a stock, but I will also say that it's not so much about, with IUL, it's not so much about what you can lose, because you don't lose very much with IUL, right? Because it has that zero floor minus cost of insurance charges and all that. To me, it's more so, what is the delta from what they illustrated and what the possibilities are with that cash value, which is much, much, much bigger usually with IUL than what it is with whole life insurance, unless you're being reasonable with those illustrations. Be reasonable with illustrations. Don't be that guy that's not reasonable with illustrations. I hope this makes sense. There is no answer to the question of which one is better. There is further clarification, however, that can be done. And by the way, I will end with this. So the equivalent of decreasing caps from a pricing standpoint is decreasing dividends. You know, this notion of dividends, and it's kind of added, it's kind of cherry on the top. And then, well, if the insurance carrier decreases those, then it's kind of okay. You know, but with caps, whoa, you know, there's more of kind of a, and I fall victim to this myself, kind of an entitlement feeling, right? Caps should remain the same. Oh, the carrier dropping caps, they're horrible. So it's like over here, it's just less of a good thing, to where over here, it's a bad thing. Well, I'll say this. Decreasing caps on the IUL side is the equivalent of decreasing dividends on the whole life insurance side. And have whole life companies, have they decreased their dividends? Yes, they have. I blacked out these names here. These are major whole life insurance carriers, participating whole life insurance carriers. And what you have here is, so this one at the top, which I won't name, 6.7, 6.23%. For those of you that know general account yields over the last decade, you know that in the IUL space, the general account yield that goes towards buying call options, they've dropped pretty much in line with the way that the dividends have dropped, which means that the cap decreases have decreased pretty much in line with the magnitude that dividends have decreased over this period of time, 6.25 to 4.7. You know, I would say that that's pretty close to, do I dare say this? That's probably pretty close to what general account yields have done. I want to say the general account yield on average in the U.S. today is around 4.5, 4.6% based off of, I think it was a Milliman study, and a decade ago or so, it was probably about that. Not that I am saying that dividends are a reflection of the general account yield, because again, there's so much more that goes into the dividend calculation than just the performance, but you get what I'm saying there. So to me, this going to this is equivalent to a cap on IUL going from, say, 13, 14% down to 9% or 10%, without looking at my bull call spread analysis in TD Ameritrade, what it costs to buy an option at the money and then sell an option at, 12%, 11, 10% out of the money. I would say that this is pretty much in line. Not that, again, dividends are an accurate reflection of what the general account yield is, because again, you have those other two components in the dividend calculation. Anyway, folks, I hope that makes sense. I hope I didn't confuse the matter here. Just know there's 100 pennies in the dollar. I don't think there is any one that's better. I don't think there's any side that is ripping off clients today. You know, this low interest rate environment that we're in, which is horrendous for insurance carriers. 10-year treasury, 1.6, 1.7 today. 1981, it was 15.84%. It's just declined steadily. This is horrible for term policies. Term policies, price increases are equivalent to caps on IUL decreasing. GUL, price increases on GUL are equivalent to caps decreasing on IUL. This, on the whole life policies, is equivalent to caps decreasing on GUL. Anyway, let me know if you have any questions regarding the banking concept. Feel free to send me an email if you want me to send you that 32-minute presentation that I did on that. Also, by the way, tomorrow, which is the 30th of January, I'm doing a video conference a lot like this, me and my trusty flip chart, talking about the Secure Act and the opportunities around the Secure Act. Hope you enjoyed this. Have a good day.